Wood. Yes, Cathie Wood was out there today, and I want to go ahead and react to all these videos that Cathie Wood basically has out there today, okay? We're going to react to it. I'm going to give my opinion on this. People betting against us are shorting innovation, says Cathie Wood. We'll watch that. We'll watch this one. I think a lot of inflation is supply chain related, says Cathie Wood. This one says our companies are investing aggressively because they see enormous opportunities, says Cathie Wood. And the last one up here, Cathie Wood buys stocks like someone who just started yesterday, says Jim Cramer. Man, Cramer, that's rough. If he actually said that in this video, which we'll get into and see if he actually said that, but my gosh, if he actually said that, that's disrespectful. That's all I'm going to say about that. So we'll leave that one for last. Okay. By the way, I want to mention here at the top before we get into this, I think Dropbox is a good example of how nasty the stock market is. They beat their revenue. They beat their estimates. It's a super low P name. It's like a 15 forward P. Stock's down 5.43% after hours. They beat 4 out of the last 4 quarters, and just this market, it doesn't care. There's a narrative in the stock market. It's like only unprofitable stocks are getting hit or super high P names. BS, man. Almost everything's getting hit in this market right now. They will find any reason to send your stock down. Doesn't matter if you're a low P name. Doesn't matter if you beat your earnings. They'll find a way to send it down right now. It's just the sort of market we're in, and that's just a good example of that one there, okay? Alrighty, guys, so we're going to get into this. Let me know your opinion on Cathie Wood in that comment section. Obviously, recently she's gotten a lot of hate. The Ark fund is down 50+% from its highs it reached around this time last year. And I would love to hear from you guys in that comment section. As always, hope you enjoy this video. Also, make sure you subscribe to the channel if you're not already subscribed. And if you want some free stocks from Moomoo, check out pinned comment down there. It's up-and-coming stock brokerage, the professionals trading platform. And also, they're doing a free TTCF share right now with a $100 deposit. Alrighty, guys, let's get into this.
Criticism is rife right now. Your stock picking prowess, as I said, your research, which you are defending multiple times here. I'm wondering what you make of the criticism, whether you think it's gotten too personal, the fact that there is literally now an ETF betting against you. What do you make of that?
Well, I find that very interesting, especially the last. When you think about it, it's simply a call. Well, they're shorting innovation, and that seems to me over time that's not going to be a business. If you ask me, consider the source. But they're also not doing any research. They're simply shorting innovation. If they were doing research and could point us to reasons why what we have included in our portfolio is not going to participate in the new world order, then we might have a conversation about it. But the idea of shorting innovation in America is ridiculous, I think. But here's what I do know.
I agree with that on a long-term basis. Yeah, it's a dumb idea on the long term. But what I will say on the short term, I mean, they're usually just doing it because they understand the market's extremely rough right now. And they felt like a lot of these stocks were obviously significantly overvalued. Maybe they've taken it too far now. It's dangerous. This ETF's down well over 50%. Yeah, I think it's really dangerous now. I'll put it like that. But if stocks get way overvalued at a particular time, I understand why they want to do it.
When I see, and this is investor psychology, when I see people so sure that we are wrong, and that they are willing to set up companies simply to short innovation, and to set up funds to short innovation. That investor psychology, the pendulum, has swung so far in one direction that if we're right, then the rewards are going to be enormous.
I don't know how else to say it. They're not shorting innovation; they're shorting you.
Well, we stand for innovation. If it's an interesting, another interesting idea that surfaces as you say that.
Once again, this is an ETF. I mean, for an ETF to be down 54%, I don't know if I've ever seen that before in an ETF. Like you see stocks, fall 50%. It's like, it is what it is. But an ETF, that's rare company. I'll say that.
Was in the bubble, but I was in the markets in the 80s and 90s. And where did investors go to access exposure to innovation? They went to the Nasdaq. And, you know, I'm looking, and we're benchmark agnostic. Our goal is to deliver a minimum of 15% compound annual rate of return over a 5-year period. So we're benchmark agnostic. And until recently, I just didn't know how the Nasdaq had evolved. So if I look at the Nasdaq 100, what do I see? I'm shocked to see in there, if you look at the overlap with our portfolios, and not just the flagship, I'm talking about all of our portfolios, the specialized ones, only 25% in the Nasdaq 100. The top 50% are the FANGs, Tesla, NVIDIA, Microsoft, roughly. That's very rough. And that's why you see so many top 10 portfolios, top 10 stocks in portfolios out there to be those. And then if you look further, you see food stocks. Like, this is not the Nasdaq I grew up with. You see like Kraft Heinz or Pepsi. You see Old Dominion and trucking. You see a CSX and rail. You see Dollar Tree and other dollar stores. You see a lot of bricks and mortar retail. And now it's that ilk of stock is roughly 10%. So what's left is what we would call either a company is going to be disrupted by innovation or they're involved in sustained innovation. So this is not the true innovation index anymore.
You know, I gotta say, that is a pretty darn good point she just made in that video. Yeah, I mean, there's a lot of not even really tech companies now in the NASDAQ. And I noticed that over a while. NASDAQ's attracted a lot of companies that aren't just in the traditional like tech space, right? So yeah, I think she's got a pretty good point there. One thing I'll say about Kathie before we go on to the next video, because he was really talking about you know folks shorting her and whatnot. The interesting thing with Kathie, Cathie Wood, is she blew up to this big fame over the past couple of years with her big success, right? Now, in the past year, she's gotten even more popular for, the fund's failure, right? And being down 54% or whatever in the past 1 year, which is crazy to think about, right? So now everybody's keeping track of Cathie Wood. Everybody's watching Cathie Wood. Heck, I even have a website dedicated to Cathie Wood that we created a while back called CathieWoodStocks.com, which tracks all their positions, for the Ark fund, the main Ark fund, all their top 25 positions. So everybody keeps an eye on Cathie Wood now. The thing is, if she hits big again with the Ark fund over the next few years, she's going to be lifted from this person of interest in the stock market to that next level of Buffett and some of the other great investors, the Peter Lynch's, some of the other great investors that we respect on kind of that Mount Rushmore. If she hits it big again over the next few years, that will be her second time hitting it big, essentially, right? And she would be lifted to this next level. Now, if Ark just continues to flounder for years and years, then she won't, right? And she'll just be another one that was a fund manager that was hot for a bit, did really good, and then just faltered. But yeah, it's interesting. She's gotten a lot of attention. So next one, I think inflation is supply chain related, says Cathie Wood.
Having swung very far, I don't know if it's all the way yet. It's hard to without the benefit of hindsight. But every time I want to pull the trigger and buy your flagship fund, ARKK, two things stop me. And maybe you can talk me and other people who are watching out of these two problems that I have. The first is not in your control, and that is the inflationary environment and what's going on with rates. If this is your strategy and you're going to stick to it, unfortunately, you're up against a headwind that is not of your making, and really there's not much that you can do about until it abates, which is that historically, go back to the last 100 years, break it down in decades. Decades with high inflation were very bad for growth stocks relative to value stocks. Just look at the 2 decades with the highest inflation, the 1940s coming out of the war and the 1970s. In those two periods...
Come on, man. I can't even... 1940s and 1970s in innovation? Come on, man. Come on.
Using FAMA French indexes, value outperformed growth on an average annualized basis by more than 10%. That is an insurmountable hurdle to anybody concentrating in growth stocks if, in fact, high inflation is going to persist. Again, that's not your problem, but I'd love to hear your take on that. The second thing is a little bit more idiosyncratic to Ark and the way that you guys do portfolio construction. which is that there tend to be a lot of glamour stocks in your index and in your products that maybe aren't that innovative. And a couple of examples that come to mind, I was kicking the tires on your genomics fund. I can't get past the fact that Teladoc is the largest holding. In what way, shape, or form is Teladoc at all involved in genomics? DraftKings.
Hey, I gotta say, I like this interview, man. It's this is serious. Like I was not expecting this. I was expecting them to, kind of softball it in and kind of like, because that's usually what they do when Cathie Wood comes on. I'll tell you, man, this is strong like Donkey Kong. Okay.
Hood. These are not really innovative companies. One is a bookie and one is a fairly traditional broker that made its way by breaking a lot of brokerage rules. I don't see innovation there when I see those names, and that's why I'm not an investor as badly as I want to be. Can you talk me out of those concerns that I have? Because I think they're shared by a lot of the people watching today.
Sure. Absolutely. And Josh, I heard that you had some kind words to say about us as a firm or generally. So I thank you for those a few weeks ago.
I think very highly of you.
Thank you.
I don't even know.
So
I don't even know if she's being facetious there or not. Like after the way he just directed those questions, I don't even know.
Inflation. Okay, my background is economics, both economics and finance, and I do have a point of view here. The supply chain issues have lasted so much longer than we anticipated that they would take a while to work out, but not 2 years. So the question is this supply chain related? And will these inflation metrics unwind? I think a lot of what's going on is supply chain related. I know it's become unfashionable to use the word transitory, and so we won't because it's lasted longer than we expected. However, I do think there's going to be the deflationary forces that are building up in the economy today are pretty strong. Two are secular, one is cyclical. And the bond market is sort of getting this. If you look at what's happened to the yield curve, so the difference between long rates and short rates, it has flattened from, I think, 155 basis points last March to 45 basis points today. And if the Fed did go 50 basis points in March, which they might, I think that it would be one and done then, we'll end up with an inverted yield curve. And then what are people going to think? Well, an inverted yield curve and the flattening yield curve says, watch out. Something's going on here. Either growth is going to disappoint or inflation is going to be much lower than expected, or both. And we think both is right. And so that's the cyclical source. There's an inventory buildup. If you look at the record-breaking inventory buildup yield curve.
That's very important. I want to play this one more time so you guys
and then what are
get
people
that.
going to
Very
think?
important.
Well, an inverted yield curve and the flattening yield curve says, watch out. Something's going on here. Either growth is going to disappoint or inflation is going to be much lower than expected, or both. And we think both is right. And so that's the cyclical source. There's an inventory buildup. If you look at the record-breaking inventory buildup in the fourth quarter GDP report, you'll get a sense, while inventory to sales ratios might be low, as the consumer switches off here. And if you look at the last 3 months of either retail sales or consumption, the consumer has gone pretty flat. Meanwhile, you've got the double ordering and triple ordering by manufacturers and wholesalers because they were missing sales before. So I think there's a big inventory problem brewing here, and it's going to hit within the next 6 months in terms of that recognition.
See, that's where things get interesting, because if that's true, it doesn't sound that great for the overall economy, and if it's not good for the overall economy, that might not be good for stocks, right? So that's where things can get a little confusing here, because it sounds like almost she's a little more toward bearish short term on the economy and on many various factors. So
that's the cyclical side of inflation. The secular side has to do with innovation. So our focus is understanding cost declines associated with technology and when costs are going to drop low enough so that demand in different sectors will pick up. Just give you a few examples. So for every cumulative doubling in the number of whole human genome sequenced in the world today, costs drop. The cost of sequencing drops 40% if you're Illumina, 28% if you're a PacBio on the long read side. Robotics, for every cumulative doubling in industrial robots, cost decline 50%. We have major labor shortages. So that cost decline will cause increased adoption and will lower the risk associated with wage inflation continuing. And then artificial intelligence costs, I gave that one, down 60% per year if you include both hardware and software. These are major deflationary undercurrents. The other side of disruptive innovation is creative destruction. And what does that mean? It means the existing world order, the traditional world order, is going to face disintermediation and perhaps destruction. And we certainly see this in everything, transportation, in retail. There's still a lot of creative destruction taking place,
right,
in the healthcare space, right? So what's going to happen is these companies whose products are either going obsolete or who have not invested enough to update them, they are going to have to cut prices. So we see major deflationary forces, and I think the bond market is on to this. If I didn't see some signal supporting what we're saying in the marketplace, like that yield curve, I'd probably say, gosh, I don't know how long this is going to last. But I have a feeling these deflationary forces have entered the bond market cycle.
Interesting there. Okay, so... man, you know, when I just watched that, I was just having some thoughts as I listened to her, and I was thinking about, you know, people used to call her Cathie Wood, the crazy lady, because she would go on and talk positive about Tesla back in the day and how they were an innovative company and doing all this and all that. And at that time, obviously, Tesla wasn't doing so well as far as the stock price went, and so she kind of got cast as like this, you know, crazy lady who just talks crazy, right? And it's interesting because I see some of that kind of coming back. I wish she would have touched on Teladoc there, because, you know, Josh Brown, he really went after Teladoc there. I would have loved to hear her stick up for Teladoc there. But yeah, I mean, at the end of the day, she feels like there's likely deflation coming when you really listen to those comments, and that's almost it's like you can't have it both ways, I guess you can say. Like, folks look at the inflation, they say that's bad, it's out of control for stocks. But then if you hear Cathie Wood talking about deflation, a lot of folks would say that's also bad. So I don't know, man. That's
investing aggressively now because they see enormous opportunities, whether it's in the genomic space, the robotic space, energy storage, artificial intelligence, blockchain technology. And when you think about artificial intelligence, I think for us, and all we do is focus on innovation. The biggest surprise to us in the last 3 years is the amazing set of breakthroughs in artificial intelligence. We've got AI costs. We've got AI moving more than twice as fast as Moore's Law. Costs dropping 60% per year if you account for both the hardware and the software. When you get the cost of something dropping that much, and to levels that are much more accessible and affordable, you're going to have an explosion in creativity. And that's what's happening. What has happened to our world, our traditional financial world, is intense risk aversion caused by, first, the tech and telecom bust in the early 2000s, and then even more so after 08, 09. And what does risk aversion mean in the traditional world? Risk aversion means get close to your benchmark sensitivity. So we have, I think, one of the most...
That's true, and that's one of the reasons I respect Cathie Wood and kind of what they're doing is, you know, they're not trying to stay close to the S&P 500, because that's the way most funds are run. Let's be honest. Their goal is to just try to keep it close to the S&P 500. So if the S&P 500, let's say, is up 10% on the year, you're trying to be somewhere in there 8, 9, 10, 11%. you know, it's kind of just, it's such a weak way of investing in my personal opinion. And, you know, why even be a fund manager or somebody running an ETF if all you're trying to do is stay right around the market? At that point, just, you know, be in an index fund if that's what you're going after. It's such a weak, you know, thing. I'm just like, ugh.
Massive misallocations of capital in the history of mankind. You have investors investing in
this is big.
Allocations of capital. Risk aversion means get close to your benchmark sensitivity. So we have, I think, one of the most massive misallocations of capital in the history of mankind. You have investors investing in the past. Benchmarks are where they are, and especially the largest companies and stocks in the benchmarks are where they are because of past successes. If we're right.
Yeah, I see what she's saying there, but that's just how most of Wall Street is. Most of them can't see the future, right? They either can't see the future and they're not trying to see the future. So they're going to invest based upon what a company's past results are and what their past success was over the past 5-10 years. Not really looking at the next 5-10 years. That's just not Wall Street's kind of the name of the game. That's Cathie Wood's specialty, is really looking at the next 5-10 years with these companies, or maybe even past that. But yeah, it's just not Wall Street. They're just not like that.
Those are the companies that are going to be disrupted. And you can see, if you look at large cap growth portfolios or large cap any portfolios practically, you'll see many of the same stocks. But in growth, you'll see the FANGs, you'll see Microsoft, you'll see NVIDIA, you'll see Tesla, because it was put in the benchmark finally. The only one we overlap with is Tesla.
Why such a reticence, though, to concede that some of these stocks that have suffered dramatic declines will never come back to the level at which they once were? You won't concede that? You think all of these stocks that I read on that list, plus others that are down by significant amounts as well, are really going to come back to the prior levels they were?
Absolutely, and beyond. You'll notice what we do during risk-off periods, and this one has been particularly long, 1 year. Which has taken our stocks into bargain basement pricing, I'll say again. But the names you read have migrated into our top 10 because we have concentrated our holdings towards our highest conviction names. And most of the names you read are in our top 10. I think many of them are platform companies. Many of them are going to harness artificial intelligence in a way that others cannot. I mean, Tesla has been the best case in point, and I think we have a lot of Tesla-like stocks in our portfolio. We're really looking for companies that are going to use artificial intelligence and create competitive advantages that no one will be able to catch.
Alrighty, before we get to the fun Jim Cramer video here, let's finish out with business first. So if we go ahead, go to CathieWoodStocks.com, my website here that tracks Ark's top 25 stocks on a daily basis. You know, if we look at a lot of these stocks, and this is a main Ark fund, by the way. They've got different funds, but this is their big dog, okay? And this is what most people buy if they want to play Cathie Wood stocks, okay? So obviously Tesla, the big beast, which has obviously had an incredible ride, right? Which, by the way, isn't even near 10% of the weight right now, 8.6%. So Teladoc number 2, TDoc. And, you know, maybe she did defend Teladoc directly. You know, maybe they just didn't put it on YouTube. But I would have loved to hear her defense of Teladoc because Josh Brown really came at that one. This is their number 2 biggest position. Roku, I believe, lower now than it was prior to Rona. That's one I've never, agreed with her on. That's just, I'm not there. Zoom's a tough one. So Zoom obviously became a super famous name in, obviously, the Rona, right? Where else in offices are closed, you got to use Zoom. They're the premier name in that space, but it has always felt like a company that, you know, is ripe for disruption, as strange as that sounds, because it's supposed to be an Ark stock, so those are supposed to be kind of disruption proof. But Zoom's always felt like kind of a company that's just, it seems like Google, Microsoft, companies like that could end up, I don't want to say replacing them, but giving them some serious run for their money. Coinbase, obviously the biggest player, when it comes to crypto companies, but there's a lot of competition when it comes to crypto brokerages and crypto exchanges. There's a lot of competition there. Exact Sciences can't speak on that. Unity Software, I can't speak on that one on a high level. Obviously, they have Square as their 10th biggest position here, which Square is, that stock's been kind of, in a really, really tough place recently. Palantir, I believe, just hit a new right around 52-week low, all-time low here today. Numbers look great, by the way, out of Palantir. It's just, in this sort of market, Shopify's the 17th biggest position. Shopify is down $1,000 a share roughly in the past 3 months. That stock's down like literally, I think it's 61% in the past 3 months or some insane number. So yeah, oh gosh, Hood, I mean, you go through a lot of these positions and they just got absolutely devastated. Some of these companies, yeah, they got good business models. Other than them, you can make an argument that they're not even the most necessarily innovative companies out there, right? So, it's a case-by-case basis. All right, let's hear Jim Cramer, what he has to say here. Cathie Wood buys stocks like someone who just started yesterday. Wow, okay, all righty.
To get your thoughts, what did you make of a day like today?
Melissa, today obviously just a terrible day. The juxtaposition of Cathie Wood on Scott's show with what happened today and what will happen with Roku, the CEO, all very painful. And I think it's painful because there's a lot of new people who've come in. And you and I have been around, Melissa, and we know that people tended to buy these very exciting stories. They bought excitement. They bought price to sales. They bought stories that sounded like you couldn't, you had the future. And there you had Cathie Wood. And you heard this, Sarah. She is giving you a view which just basically says near-term price doesn't matter. But we have people who are terminal value buyers who can't have that staying power. Yes, when you go to play blackjack at the casino, it's 51.49 if you can hang on long enough. But most people can't. And what we're seeing are people who are being blown out, even as she's soothing. And I found it very disturbing.
Should we judge Jim?
I live in Vegas. Mainly I'm at my Arizona house right now. But, I just heard Jim speaking about blackjack odds, and I was thinking to myself, wait a minute. The player never has the advantage in blackjack, if I recall, and I just had to look this up. Yeah, even if you're an experienced player, the house still has an edge in blackjack. So just want to clear that up before everybody moves out to my city, Vegas, and becomes professional blackjack players. Don't get your hopes up too much, okay?
Should we judge Jim? Should we judge her now? I mean, her highs in our ETF was February. Is the time frame too short? I understand your point. I understand that a lot of people have lost a lot of hard-earned money, but is our time frame just too short to judge a bet on innovation?
I've been talking to many managers about that, and all of them said the same thing, which is that if it were a traditional fund, all of the money would have been pulled out because people can't afford to lose that amount. Look, I think that innovation is a terrific thing, but I think that the way it should work is you should have research people, and by the way, I thought it was a great question by Scott as anyone fired. You should have research people who are doing technology. And then it is given to people who do securities analysis, and then it's given to a trader who tries to figure out what's the correct price. She has just clearly skipped step 2 and 3. And I don't mean to, I like what Josh Brown said, and I have great respect for her. But the fact, and I would never do this ARK, this short fund, but the fact is she's more emblematic of the moment. And we had people who were emblematic of the moment in 2000. And they are, and I was just telling to Sarah during the break, true believers. And true believers are terrific. But Melissa, the problem is that, as one of our guests said earlier, there are no bids for the true believers. The only real buyer of some of this merchandise is Cathie Wood. You cannot create a market yourself. Nobody's that big. I do when I see her buying things. I am shocked at what she buys and how she buys. She buys like someone who just started yesterday.
Well, but also, I think the structure of it. She's an ETF. She has to stay fully invested. She has to keep buying. I mean, the conviction, I think, is what you're talking about. So would you touch any of these ARK names?
I actually okay, so let's distinguish. I actually like some of these companies. I dislike the way they were bought. And I really hate something called hubris. Hubris is horrendous, okay? Humility is important. When I screw up on something, like when I screwed up on PayPal, I own it, I wear it, I'm furious at myself, but I screwed up. I would never in a million years tell you, but you just wait. You just wait, Sarah, because when that thing comes back, who the hell has the right to say that.
Well, and she also says the market is getting it completely wrong.
Well, there is no such thing as the market being completely wrong. The market is an assemblage of tremendous minds getting together, and you may think they're weighing machine, voting machine. That's all nonsense. The market is about trying to minimize losses and make as much money as possible. That's what the market is. And if you don't think that minimize losses means anything, then you should just be running your own money and nobody else's.
Okay, yeah, big difference of opinion there. If you're a trader, sure, if that's a trading mentality, but that's traditional Wall Street. And I think why is Cathie Wood so popular? What attracts people to Cathie Wood, for instance, right? She's different than most folks on Wall Street. Most folks on Wall Street are doing the same damn thing that Jim Cramer wants her to freaking do, which is try to keep around the benchmarks and, try to keep your risk at, as minimal as possible. And, that's just a freaking bunch of BS. At that point, if that's all you're trying to do, buy the flipping index funds at that point and just track the S&P 500 for Pete's sake. There's no point if that's what you're doing. Like that's just a finesse on the system at the end of the day. What makes Cathie Wood interesting is that she's willing to take those risks with her fund, and she's willing to make some bets on some companies that some people say, I don't know about that. Just like Tesla, people were like, I don't know about that. And some of those stocks probably aren't going to work out that are in her fund, and they might never hit the prices they already hit in the past. And some of them might hit massively, kind of like Tesla did, right? But at the end of the day, that's what makes her interesting. That's what makes her fund interesting. And for her to try to have to change her strategy to appease following around the benchmarks is just stupid, in my opinion. That's the same exact thing. And I don't even have one dime invested in ARK funds. But I'll say, that's a stupid approach. That's just, at that point, just S&P 500 index fund it. Why try to chase around the indexes when you could just be part of the indexes at that point in time? Like I said, what makes Cathie Wood's fund interesting is the possibility of massive outperformance, right? And in a down market, in a downtrending market, in a market where folks want to take no risk, which is a market we're in right now, let's be quite clear about that. You know what's going to happen to ARK? It's going to do horrible. But guess what? Most of the time, the market is not like that. Most of the time, folks do want to take risks because at the end of the day, what do people really want to own? They want to own the big growth companies. They want to own the big revenue companies. You get through these time periods where people are like, when I say people, I'm talking about investors, right? Wall Street, where they're all out. They're like, no, I'm risk off right now. I don't want to take any risk. I don't want to buy anything like that. Okay? That happens every once in a while. But I can tell you that most of the time the market is not like that. If you look at the market over the past 25 years, the last 30 years, what do people actually want to be in? They want to be in the big growth names. They want to be in the story stocks. They want to be in innovation, okay? And that's where Cathie Wood likes to play. And so she's going to have these time periods when she looks awful, which is what she looks like right now. 55% down in ETF is awful. But believe me, she will have her time in the sun again. And you got to be very, very careful. I don't know how much research people have ever done into on how Christianity got so big. But if you never went down that rabbit hole, go down that rabbit hole. And if you want to try to kill something off, just be ready. Because, on the other side, when things flip, you got to realize you just created a religion way bigger than you ever anticipated it to be when you try to kill it off and speak down on it when it was down and out. Very important to remember. So anyways, guys, let me know your opinion in the comment section. I'd love to hear from you guys as always. Make sure to subscribe to the channel if you're not already. Also, get your free stocks from Moomoo. Pin comment down there. Free TCF share with a $100 deposit before they end that. Much love and have a great day.